Welcome to American Dreams. I'm here today with Brian King. Brian, welcome to today's show.
Thank you so much for having me.
So, Brian, for the listeners here, can you give us your background and how you got to where you are today?
Yeah, so my background has mostly been in the stock exchange world. So in the Kansas City area, many people might be familiar with BATS Exchange. It grew to be the third largest stock exchange in the world. I was fortunate to be a part of that startup team. And I had the fortune of being able to also move over to London to be able to start BATS Europe. That was an exciting time to be able to build that. We were the first pan-European exchange. I moved back. I helped to start our options exchange and then our ETF business. And so a really cool path there. The Chicago Board of Options ultimately bought us. Around that time, I left and I went to the New York Stock Exchange and spent about 5 years there overseeing trading and market structure and ETFs. And then saw this tremendous shift towards alternative investments. And ultimately, I knew that that's kind of where the puck was going in the financial markets world. So I wanted to be a part of that. And having built so many marketplaces, ultimately what we did is we created a secondary market for alternative investments. And then we also, once we saw that, we built that product, we realized how significantly dated the operational ecosystem is for alternative investments. And so we also created a transfer agent product as well. So within our ecosystem, we really can help people from everything from fundraising alternative investments all the way to it's managing those assets, all the way to the ultimate exit through a secondary event.
You were able to sense a gap in the market launching the BAT Exchange. The New York Stock Exchange is a fairly competitive environment. You don't see people starting new exchanges every day. When you first started off, what helped you get a sense of that this BAT Exchange was going to succeed?
Yeah, so I was fortunate to be a part of that startup, but Dave Cummings was the founder of BATS Exchange, and he had a significant trading business. He was one of the pioneers of automated trading, so what has been later coined as high-frequency trading, and he did that through TradeBot. So that's another company that's based here in the Kansas City area, and again, very successful, but because there was kind of a duopoly between the New York Stock Exchange and NASDAQ, there wasn't a tremendous amount of competition for innovation among the exchanges. So he basically saw the opportunity to say, hey, if we were to create a new exchange, it would really forge an opportunity for firms like us who leverage technology to be able to really succeed and thrive in that ecosystem and really evolve the marketplace. And ultimately, that's exactly what happened. And so there are a lot of major financial institutions, bulge bracket firms, trading firms that had a very vested interest in the success of BATS, and so they became investors in the organization and really were a lot of the catalyst for that early success.
What was the attraction of Kansas City? You got on the market, Pacific Exchange, New York Exchange, Chicago Board of option indexes, but Kansas, this was a new venture coming into the trading world.
It is, yes. So again, I think a lot of it was convenience from the point that this is where Dave is based, and so when he was founding that company, since it was here in Kansas, that was the big driver. Is just it was here. Now, but when you look at the two biggest competitors, NASDAQ and the New York Stock Exchange, both being in New York, they had a significant cost disadvantage, right? To be able to operate those exchanges in those cities is very, very expensive. Overhead between office space and what you're paying employees, et cetera. But there was a really significant marketplace, not just because of the type of how inexpensive it is to operate an office here, but there's a large talent pool of engineers, and at the end of the day, the exchange is a technology company, and so to be able to leverage some of that existing technology talent that's based here in Kansas City was a big advantage, and because you could do it at a dramatically lower cost.
What inspired you to start Lotus?
So again, it was really the idea of opportunity. As I mentioned, I saw a major market shift in the ecosystem. One of the biggest things was, and we've heard this a lot, but companies are staying private longer, right? So because of that, a lot of investors were wanting to be able to participate in those private markets, be able to invest before those companies go public. But even bigger than that for me as a catalyst of why I wanted to start Lotus was because we started to see this other shift happen where historically the bulge bracket firms like the JP Morgans, the Morgan Stanleys, Goldmans, et cetera, that have wealth advisory channels, they did not historically expose their clients to a lot of alternative investments. And so now all of a sudden we saw that they were exposing them to alternatives. That was a big change than in what they had done in the past. But even more so, they also were now creating products for that. And so when you start to see these massive institutions start to create product and start to change behaviors towards something, you know that that's kind of where the puck is going. And the more you have individual investors investing in alternative investments, the more important liquidity becomes. And so again, becoming an exchange, helping, I'd spent my whole career in the exchange world making, candidly, liquid things more liquid. The idea of being able to make illiquid things more liquid was very desirable.
Have you found in today's environment of, quote, illiquidity that the exchange has been more popular?
Absolutely. So timing of when we launched our business, we were kind of going through the blueprinting and kind of the ideation of it in 2020. We hired our first team members to start building it in 2021. And if you recall, obviously that was right in the throes of COVID. And there was a lot of concern that people had with liquidity. And it did have a massive impact on real estate. So when we think of alternatives, the types of alternatives that we trade today, largely those are real estate related investments, funds, really all types of structures, energy funds and private credit funds. And we've seen big movements in all three of those areas, but especially on real estate. So being able to create liquidity events for some of these real estate funds where people are maybe nervous about what's happening or other things like that, it gives them flexibility that historically they had not had.
Hedge funds and the REITs seem to have recently come under fire with the change in interest rates and liquidity. What has been the primary challenge for keeping those things solvent and tradable?
Yeah, so I think right now for us, we're a young company, so early days, it was just letting people know that we exist. We were fortunate that right out of the gate, we had a lot of buyers kind of show up. They were very interested in being able to provide liquidity. But candidly, as we've grown and we have tremendous additional products on our marketplace today, you might have a lot of people that are very interested, but they might be interested in this subset of funds or products or real estate deals, et cetera. So we're constantly needing to find more people to be able to diligence each additional fund that gets added to the marketplace. So that becomes the biggest thing for us is in order to find liquidity. Most things have a price. It's just really trying to figure out what exactly that price is. If it's a registered fund, they're filing their information with the SEC, so you can diligence it pretty easily. If it's a private fund, it's a little bit harder to find exactly what that valuation is. It depends on how much information that sponsor of that fund is willing to disclose.
I'm going to jump over to alternative investments.
Sure.
What are some of the alternative investments that people don't realize that they are able to invest in through an exchange?
Yeah, so I think some of the most common ones that we have today are we do a lot of secondaries for private credit funds. So that could be in a BDC structure or some other type of a note. And private credit is really significant right now because the banks are largely locked up in the environment that we're in today. So there's a lot of people that are issuing debt. And so to be able to create a secondary environment there has been very attractive to a lot of people. Especially if you think about the fact that you can get a yield at, let's say that yield on private credit is 10%. But if it's in an alternative investment and somebody's looking to have a secondary event, usually there's a liquidity discount built in, right? So they might get it at a 10% discount. Well, if you can get the investment at a 10% discount, not only is there a price appreciation opportunity there, but there's also, you're getting a higher yield, effective yield, because you're buying it at a discount too, right? And so that becomes an extra value. Like I mentioned earlier, energy funds are pretty heavily traded on our marketplace today, whether it's renewable energy or oil and gas type funds, a lot of different land type investments. Of course, you do have a lot of private equity and VC, and I think there's been a lot of those that have fallen out of favor a little bit, because I think going into 2020, there was some really incredible pricing that was happening for some of these individual companies that were inside of those private equity. So they were raising money at really incredible valuations. And I think there's been a bit of a reset there. And so being able for some of those people to say, realize what those markdowns might actually be, it's been painful. And so some people aren't sure where that bottom is going to be. So they're looking for liquidity today. Say, you know what, I want to remove myself. But anytime people are saying they want to remove themselves from risk, usually that's opening up an opportunity for other people that want to be buyers in that situation, right? They say, well, it might be depressed now, but there's probably going to be an upside at some point in the future. So one man's crisis is another man's opportunity.
Do you have minimum requirements before a company is able to list on your exchange?
Largely, no. So if it's a registered fund, there's typically, like, again, they're filing Ks and Qs, so their information is readily available. Rarely do we have a situation where we wouldn't list that fund on our marketplace. And then from the private funds, usually they have to be able to disclose at least some amount of information. There's oftentimes some type of a transfer restriction, whether it's first rights of refusal. And so if it's a private fund, we need the sponsor to sign off and say that, hey, we're allowing secondary transactions here. But assuming that they say yes and they're good with it, as long as they make some minimal level of disclosures of the investments and that type of thing, so that a buyer can legitimately diligence it, then we'll allow it to trade on our marketplace.
So there's really not a size or a volume required.
Not really, no. Again, we're a technology company at our core, so we operate in some ways as a SaaS type of a model for some of the things that we do. Secondaries is a little bit is definitely transactional, but from our perspective, being able to match buyers and sellers, it's an automated function, right? So we match them fully in a fully electronic way. And so it doesn't really matter to us what the size of the transaction is. But I will say, because we're dealing with largely private investments, to be a buyer on our marketplace, at a minimum, you have to be an accredited investor, right? So we have a lot of institutions that are buyers, a lot of family offices that are buyers, but at a minimum, you have to be accredited.
How does a person sign up for your fund as a buyer?
Yeah, so to become a buyer on our marketplace, they can go to our website, which is lotusmarkets.com, and it takes about 5 minutes to set up an account, so it's really easy and fast. And then, assuming that the person's approved, they would be able to, because you are effectively setting up a brokerage account. But assuming that you're approved, then you'd be able to trade right away, and so be a buyer and see opportunities. We operate in a fairly traditional format where we have limit orders on buys and sells, but also a buyer has the ability to express their interest in various investments through an IOI. So it's non-binding, but it says, I have an interest in being a buyer in this particular fund at a set price or price range.
Can accounts be custodied at the main brokerage houses, or does everything need to be custodied at your exchange?
So yes, we can work with all the different custodians that are out there. We can work with Schwab, Fidelity. We do have a custodian that we partner with when we need to have a custodian involved, and that's called Axos. It's a large bank custodian, but it's a very alternatives friendly. So we work closely with them. But no, you're not required to custody something with us.
Okay, so the Lotus markets being relatively new, uh, how do you maintain the high degree of confidence in this trading platform? Obviously, a lot of people want to come to you and say, hey, we need liquidity, so let's come jump in here. And, how do you stop the people from coming in that you really don't want listed on your exchange, meaning that maybe they don't have complete disclosure information, or it could be problematic for buyers?
Yeah, so good question. Fortunately, we haven't really had too many of those types of problems yet. But at the end of the day, we are gatekeepers of what funds get listed on our marketplace. And so we do have final say and discretion over that. And so for us, we are able to kind of maintain that type of integrity. And we have a compliance department within our organization. They're able to do diligence on each individual fund that's listed on our marketplace. So we take that very seriously.
Are companies required to undergo audits, financial statement audits?
In many cases, the answer is yes. In most cases, the funds that we have, that's a natural part of their organization that they're doing audits, and we can have access to those and that type of thing. And if they're made available, we try to make it readily available on our marketplace. So we have some really cool data tools that we've built, and that helps any buyer that's coming in to diligence the fund. It really displays their data very, very elegantly. In some cases, so Blackstone, for instance, Blackstone, their BREIT fund is listed on our marketplace. We actually have more financial data about BREIT on our marketplace than they have on their website. So it's a really interesting place to be able to look and diligence different types of funds and maybe even learn about those different funds.
So the pricing trends. When we're dealing with fairly illiquid investments, obviously there's a gap, the market discount. Market rate, is that set, or how do you guys come to the determination? Is all that done electronic trading, or offer at one price and seller at another price, or?
Yeah, so it's a great question. So many of the funds that are listed on our marketplace, they do strike a NAV. Those NAVs are either struck on a monthly basis or a quarterly basis, or sometimes as rarely as a yearly basis. But for the most part, they have some type of an NAV that reflects their net asset value per share. And so, and usually trading happens at a discount to that price. And so there might be some situations in the future, we haven't seen it yet, where it could be at a premium. You referenced hedge funds. There are sometimes hedge funds they perform really well, but they're closed. They aren't taking in new investors. And you could imagine a scenario where somebody really wants to get into a particular fund that's performing really well, but somebody else has a need for some reason to exit. You could see how there could potentially be a premium to get in. We don't operate in that world right now. We aren't seeing a whole lot of premiums for these for alternative investments. Usually it's at some element of a discount, but those prices are often driven by the buyers. So usually the buyers come in, they diligence the fund, and they say, this is the range in which I'm open to being able to buy. And the seller then can see that price, and they can enter in their own limit order and say, well, I don't like that price. I'd like to be able to get a little bit more for it. And they could put in their own offer price. And so the buyer then might be able to see that, and they might lower their price. And so it's all automated display, but each individual is kind of triggering where they're willing to be a buyer or a seller. So we don't drive price. We don't make recommendations. We're just a place that helps facilitate those transactions and then provide as much transparency as we possibly can to those who are looking to execute.
The trend with illiquidity solutions, it seems that with these credit markets still relatively tight, what do you see for the future in the next 5 years with your exchange?
Yeah, so my hope is that, and I'll answer that question with a real live scenario. Our hope is that we'll see prices really compress, right? Spreads compress. So last year, I referenced earlier Blackstone's BREIT. It's one of the more famous alternative investments. It's a big household name. Blackstone is, and their BREIT is at the time was a $70 billion fund. And so because of some of the things that were happening in the market, there was a significant rush towards the exit. And BREIT has a built-in liquidity mechanism in their fund. So on a monthly basis, they provide up to a certain percentage of their assets can be redeemed. And so people can make their shares available for repurchase from the fund. But there were so many people looking to sell last year, literally multiple billions of dollars oversubscribed for that redemption queue. So they weren't able to meet their redemption requests. And so because they were so significantly oversubscribed, people wanting to sell that couldn't sell, we listed it on our marketplace and made it available. When we did that, there were a lot of institutions that got very excited about the opportunity to be able to buy at a discount. So they came in and were saying, we'll buy at 10% discount or 15% discount. And while I can understand their rationale for wanting to put that kind of a discount on it, we had other investors, particularly financial advisors, who they have a mandate for their investors to be able to buy their funds, to be able to buy Blackstone into their clients' portfolios. So they could either buy their funds directly from Blackstone at NAV, or they could buy it at a discount on Lotus. And so what we saw is the spread compressed dramatically, where now all of a sudden people were bidding and executing at a 4% discount, which is significantly better than what the institutions were bidding. And so we saw that spread decrease dramatically. And so I believe that as the alternative investment world evolves, we'll continue to see those spreads decrease. Now, I've used this analogy before, is, when somebody, because a lot of these funds are trying to create a mechanism that allows them to be buyers, to buy back their own shares for liquidity purposes. But if you buy IBM stock, IBM doesn't need to sit on a pile of cash to be able to buy back your shares when you need liquidity. There's an exchange that helps to match those buyers and sellers, right? And so very similarly, you have a real estate fund. That real estate fund shouldn't be the one that has to buy back those shares. There should be an organized marketplace that efficiently can match buyers and sellers. And so the more that trend evolves, I believe we'll see those spreads really, really compress. And I believe that will unlock the future for more people having an interest in being able to participate in the alternative investments. Liquidity is the number one barrier.
So, Brian, it's been a pleasure having you today on the show, American Dreams. Person wanting to access your exchange, how would they go ahead and do that? One more time for the listeners.
Yeah, so they can visit us at lotusmarkets.com. Lotus is LODAS. That stands for Liquidity on Demand as a Service. And so they could visit us there. They could, of course, contact me and follow me on LinkedIn, Brian King. So I'm happy to have any conversations with people that want to learn more.
All right. Thank you, Brian.
Awesome. Thank you so much.